Hello everyone, this is Elliot Yu with the Free Market Speculator and the Energy Bulletin. Thank you for joining me today. Now if you follow the metals markets at all, you may have noticed something interesting, something unusual lately. And specifically I'm talking about the fact that gold and silver have been kind of chopping around, looking a little tired after their big moves earlier this year, those parabolic moves we saw particularly in silver to well over $100 an ounce. I believe the closing high in late January was over $115 an ounce. But while the precious metals are lagging a little bit right now, something big is happening in the industrial metals sector. Specifically, I'm talking about copper, the red metal. Well, it's breaking out. Copper has been showing real resilience, trading back near its highs from January as well, while silver and even gold remain noticeably below their recent peaks. Now that's the kind of divergence that makes me wonder, is this just, random market noise? Or could copper be giving us an early warning signal that silver and or gold might be ready to play catch up? So today we're going to dive into 26 years of historical data to answer one question. When copper leads, does silver follow? We're going to look at a simple, easy to understand trading rule and see what history actually shows when copper leads and silver lags. Now, if you're a silver bull, you're going to want to see this, and probably also if you're a silver bear. Let's start by looking at where we are right now. So this first chart that I'm putting up on your screen now, it just shows the price of silver, and really that's front month silver futures prices since the end of August 2025, so the end of last summer. That's the blue line here, and it's scaled on the left-hand axis. Now that's in dollars per ounce of silver. Now the orange line, well, that's copper. Now this is priced in this case, in US dollars per pound, and it references the right-hand scale on my chart. Now, as you can see, both metals have been generally strong since last summer, and both metals set their highs back in, as I said, January this year. However, look closely at that orange line. That's copper. By the end of last week, copper prices had almost matched the January closing high, while silver prices remain well off that late January closing high. In fact, down about 29% or so. Here's a second way to look at it that's perhaps cleaner to see. Now this relates directly to the signal I'm going to talk about today. Now this chart shows the current price of each commodity relative to its closing high over just the past 30 trading days. So that's a little over a month. So a reading of 0% on this chart would suggest that the commodity closed at a fresh 30-day high last week. While a reading of, say, negative 10%, that would tell us the commodity was closed last week about 10% below its 30-day high. Now again, silver again on this chart is blue and copper is orange. So as you can see, we're sitting here in mid-April 2026. This week, copper finally cleared its February and March technical resistance levels, hitting a fresh 30-day and in fact 50-day high. In fact, it's trading at the highest level since that January peak, as I mentioned. But look over here at silver. Now, silver is currently sitting roughly 8.25% below its own 30-day trailing peak. And it's also down some 29.8%, as I said, almost 30% from its closing high back in late January. Now, usually, these two metals move kind of in lockstep. When they don't, it creates what we call an intermarket divergence. Now, historically, these divergences don't last. One of two things happens. Either copper is lying and it's about to collapse, or silver is sort of coiling up, consolidating, whatever you want to call it, and it's about to launch higher. To find out which one it is, we have to look at history. So what I did is I pulled the daily pricing data for copper, silver, and gold going all the way back to August of 2000, so some 26 years. That's over 6,400 trading days of history. Now we're going to look at, as I said, at a simple, easy to understand rule and see what history actually shows when copper leads and silver lags. Now here's the exact setup we tested. We looked for days when copper made a new 30 trading day high. At the same time, silver was lagging. Now again, specifically trading at least a 2%. We also tested 3% and 4% silver prices below that 30-day high. So copper making a new 30-day high, silver prices down 2%, 3%, or 4% or more below their own 30-day high. Then we measured how silver performed over the next 10, 20, and 30 trading days. So why focus on this? Because copper and silver share important connections. Okay, on the supply side, silver is actually often a byproduct of copper mining. So miners who target copper also produce ounces of silver. That's why you see these streaming companies, for example, names like Wheaton Precious Metals, right? Actually contracting with big copper miners on copper projects where they actually purchase the stream of silver produced from that copper mine. On the demand side, both metals respond to industrial demand to an extent from things like electronics, energy, even electric vehicles. So when copper shows strength, it's frequently acted historically as an early signal for the broader metals complex, including silver. So what did the numbers tell us over time? Well, here's a table showing the exact results. And I know it could be a little hard to see. If any of you would like a copy of it, I can post it here over the next few days. But let's focus on the 3% lag version, which turned out to be the cleanest and most balanced signal of any of the signals I tested. Balanced by meaning the most, not too many signals, but not so rare that it was tough to statistically test. When copper hit a new 30-day high and silver was at least 3%, so 3% or more behind its own 30-day trailing high. So over the next 10 trading days, silver outperformed its normal average return by about 0.91%. So basically what I meant by the normal return, it's just the rolling average 30-day price change in silver over the entire 6,400 trading day period I studied. Now over 20 trading days, the excess return for silver over that normal amount rose to 1.82%. And over 30 trading days, silver delivered an average excess return of 2.53%. Now these numbers aren't huge, on any single day, but they do add up meaningfully over a few week period of time. More importantly, they are statistically significant in the data I looked at. So you can see that here. Look at the p-values, which is the rightmost or last column on my table. For those unfamiliar with statistics, the 30-day performance for silver following these copper lead figures, the p-value is 0.0001 for that 3% signal I just outlined. And what 0.0001 on a p-value means is it means that there's a 99.99% probability that this relationship we're examining isn't just a random statistical fluke. It's not due to chance. Copper strength truly pulls silver higher. Now let's talk about how reliable this signal has been in practice. Let's look at the win rates and the risk-reward ratios for this strategy, if you will. For the 3% lag filter, which I outlined as being the best that I looked at, 3% or more. So copper making a new 30-day high, but silver down 3% or more from its own 30-day trailing high. So the win rate averaged between 63.6% and 64.9%, depending on the horizon you looked at. Average winning trades were around plus 5% at 10 days, climbing to plus 10.56% at 30 days. Average losing trades were much smaller, roughly down 4.5% to down 6.2%, again, depending upon the time horizon. Now that produced profit factors between 1.96 and 2.97. So what it basically means is that the wins were substantially larger than the losses. Now the 2% lag, so in other words, copper makes a new 30-day high, silver is 2% or more down from its 30-day trailing high. That'll give you more signals, but a lower win rate. And then the stricter 4% or more lag, obviously that's going to give you fewer signals, a little bit stronger results, but I think overall the 3% version struck that best balance between trade frequency and the quality of the signal. Now here's the practical takeaway. When copper demonstrates clear short-term leadership while silver is lagging by a noticeable amount, right? History has often rewarded patience with above average returns in silver over the following sort of 2 to 4 week period. So how do we trade silver, right? Well, I went ahead and tested multiple technical strategies, common technical strategies against this copper lead signal to see which one handles, silver's notorious volatility the best. We looked at, moving average crossovers, one shorter term moving average above another, Bollinger Band breakouts, basically volatility breakouts, relative strength index, mean reversion triggers. So the clear winner, well, the copper lead strategy. So to create this table, as I said, I examined a number of classic technical signals on silver, starting with $100 in equity back in August of 2000. The list includes, a simple moving average crossover signals. As I said, you can see which ones I looked at here. A trend following signal, the Bollinger Band breakouts, mean reversion signals using the 14-day relative strength index. Now these strategies are all long only, so only going long silver. But as you can see, the copper lead strategy I just outlined actually performs best with a higher win rate, smaller maximum drawdown. Also note that I did look at this same basic strategy for gold. In other words, looking when copper makes a new 30-day trading high and gold is still below its 30-day trailing high by various percentage amounts. And it does also provide a useful signal, but they're not quite as strong or quite as statistically significant. They're still statistically significant, but you're not seeing those p-values of 0.001. Of course, there's no way to know for sure why the silver signals are better than the gold signals. However, I'd posit that it's down to the fact, as I said earlier, that copper is an industrial metal. Gold is mainly influenced more by monetary factors, the things like inflation, central bank policy, currencies, right? And silver is kind of a bit of blend of both, right? It's correlated to gold. It's more volatile, but strongly correlated to gold, as we've examined in prior issues of this service, prior videos. But it also has some industrial demand factors. Of course, I also want to be very straight and clear with you. No single signal is perfect. And I personally don't trust, black box type trading strategies in isolation. I use technical observations like this as just one piece of the puzzle, albeit an important one, never the whole picture. However, let's bring it back to today, the current situation. As of this recording, copper is at roughly $6.10 a pound. It's officially in a breakout regime on that new 30-day and in fact new 50-day trailing high. Silver, meanwhile, is trading around $81.70 an ounce. Now, as I said, while copper is at a fresh 30-day and 50-day high, silver is still well off that 30-day peak, its own 30-day peak. It's down to the tune of about 8.25%. So the red metal is sounding the alarm, the bullish alarm. History says that the gap is likely to close and then some as silver plays catch up to the breakout that's already happened in copper. Now, two additional points I wanted to bring up today. First, I have published several posts and videos about silver and gold here on this service over the past 6 to 9 months. I'm going to link to some of those articles below. If you're interested in seeing how I look at the precious metals, how I analyze the metals, why we were so bullish on these metals, frankly, a couple years ago, check out those links. I think two of the most interesting recently are a February 8th video that I put out, the 1970s blueprint, where I examined actually how the parabolic rally we saw in silver in January of this year actually had a positive read-through. It was a bullish signal for oil and energy stocks. And that video actually turned out to be really prescient because oil and energy stocks really took off after that, even before Operation Epic Fury in Iran. And so oil did follow silver with a lag, as it historically has done, as I explained in that video. Now, I also wrote a piece back on December 29th, the end of last year, explaining why I believed it was time to start taking some profits on rallies in the precious metals. Never advised getting out of all the precious metals, but in the paid tier of the service, we did actually go through and start taking profits on silver. We were in the SLV ETF, as well as related stocks over this period. Now, the second thing that I wanted to bring up today is I'm actually thinking about making quick videos like this a regular weekly feature of this service. Now, of course, I look at charts and economic data and trends, all week long, every day. But I usually kind of do a deeper dive on Saturday mornings when there's less distraction from those flashing quote screens, beeping trading services and open markets. So I was toying with the idea of highlighting a single trend or chart that caught my attention in my weekly review of markets, and then publishing my thoughts as a video on Sunday afternoons, much as I'm doing this week, right? Now, I've opened up the comment section today to all readers. Normally, I only allow comments from paid tier readers in most of my posts, but I've also opened it up to free tier readers, and I would appreciate hearing your thoughts and your feedback on that idea and whether you find this sort of information useful. Also, any questions you have or suggestions for future topics, well, that's always welcome. And of course, I always appreciate you dropping a like, the little thumbs up button or heart button, depending upon where you're watching this, if you found this video useful. Now, apparently that helps with engagement and the algorithms. Of course, only do it if you actually enjoyed this video or found it useful. I'm also running 30-day free trials to the paid tier of this service through the end of the month of April. If you'd like to check out our specific recommendations, again, for both the Energy Bulletin and Free Market Speculator services, it's all one subscription. You get access to both our energy-specific portfolio and our broader market portfolio in the Free Market Speculator, which includes silver, gold, as well as all kinds of other sectors. Thank you again for watching this video today. I appreciate your time, and I'll talk to you again very soon. Thanks again.